Let me be blunt for a second. If credit cards actually made people richer, banks wouldn't be pushing them this hard. Think about it. Everywhere you go, online, at the mall, even at checkout counters, someone's trying to get you to sign up for one. And they always pitch it the same way. Cashback, travel points, free perks, build your credit. It all sounds like you're getting rewarded just for living your normal life. And honestly, at first glance, it does feel that way. You swipe your card, you get what you want, and your bank account doesn't even move. No cash leaving your hand, no immediate drop in your balance, just a smooth, almost invisible transaction. Then later, you check your app and see you earned points on top of it. So naturally, a lot of people start thinking, wait, why wouldn't I use this for everything? But here's the part that doesn't get explained clearly enough. A credit card doesn't change how you pay. It changes what you feel when you spend. And that difference is where everything starts. Now, before we go deeper, let's clear up something simple that still confuses a lot of people: the difference between a debit card and a credit card. With a debit card, it's straightforward. You're spending your own money. If you've got $1,000 in your account and you spend $200, you're left with $800. You see it instantly, and more importantly, you feel it. There's a natural limit built in because once the money's gone, it's gone. A credit card doesn't work like that. When you swipe a credit card, you're not using your own money at all. The bank is covering the purchase for you, and you're basically agreeing to pay them back later. That's it. That's the whole system in one sentence. But psychologically, it doesn't feel like borrowing. It feels like nothing happened. Let's say you buy a $1,000 phone. If you pay with a debit card, you'll probably hesitate for a second because you know your account is about to drop. You're aware of the cost in real time. But if you use a credit card, that hesitation is a lot weaker. Your account still says $1,000 after the purchase. You walk out with the phone, everything feels fine, and no immediate consequence hitting you. Same purchase, same price, completely different experience. And over time, the small differences start to add up in a big way. Now, technically, the bank doesn't expect you to pay them back right away. Instead, they give you what's called a billing cycle, usually around 30 days. At the end of that period, you'll get a statement showing everything you spent. If you pay the full balance on time, you won't be charged any interest. And this is where people start to feel like they've figured out the system. Okay, so I can borrow money for free, earn rewards, and just pay it off every month. That sounds like a win. And to be fair, if you're extremely disciplined, that can work. But that's not how most people actually use it. Because there's another layer to this that quietly changes your behavior, your credit limit. Every card comes with a limit, which is basically the maximum amount the bank is willing to let you borrow. Maybe it's $1,000, maybe $5,000, maybe more. And the more you use your card and stay on time with payments, the more that limit tends to go up. At first, it feels like progress, like you're being trusted, like you're moving up financially. But what's really increasing isn't your income, it's your capacity to take on debt. And once that limit grows, your spending usually grows with it. You go out to eat a little more often, you stop thinking twice about smaller purchases, subscriptions, online orders, random upgrades. It all feels manageable in the moment because nothing is hitting your account directly until the end of the month shows up. And suddenly, all those small decisions are sitting there as one big number that you now have to deal with. That's the shift most people never notice. A credit card doesn't just make spending easier, it makes spending feel easier. And once your behavior changes, everything else starts to follow. So at this point, you might be thinking, okay, so as long as I stay in control, pay everything off, and collect the rewards, what's the downside? And that question right there is exactly where the trap begins.
So let's go back to that idea for a second, the one that makes credit cards sound like a great deal. If I just use the card, pay everything off on time, and avoid interest, then I'm basically borrowing money for free, right? And technically that's true. But in reality, that's not how most people actually use credit cards, and the system quietly nudges you away from doing that perfectly every single month. Because when your credit card statement shows up, it doesn't just give you one clear number to pay, it gives you options. You'll see your full balance, maybe it's $1,000, and then right below that, you'll see a much smaller number labeled minimum payment. Maybe it's $25 or $30. Now, think about how that feels for a second. Paying $1,000 in one shot feels heavy. It forces you to slow down, maybe even regret some of your spending. But paying $25? That feels easy, almost harmless. And that's exactly the point. Because the moment you choose that smaller number, even just once, the system starts working differently. Let's say you have that $1,000 balance and you only pay $25. The remaining $975 doesn't disappear, it just rolls over into the next month, and now interest starts building on top of it. And credit card interest isn't small. Most cards today sit somewhere around 20% or even higher, and it compounds over time. So now you're not just dealing with what you originally spent, you're dealing with a growing balance that quietly gets heavier every month. Now here's where it gets real. Imagine you carry a $2,000 balance and only make minimum payments. You might think you're slowly chipping away at it, but in reality, a big part of your payment is going toward interest, not the actual debt. So the balance barely moves. Months go by, then years, and by the time it's finally paid off, you've spent hundreds, sometimes thousands of dollars extra, not on anything new, just on interest. And the tricky part is, most people don't fall into this all at once. It usually starts small. Maybe one month you spend a little more than expected, maybe something unexpected comes up, or you just don't feel like draining your account to pay everything off at once. So you leave a small balance, thinking you'll handle it later. But once that balance carries over, interest kicks in, and now you're no longer playing the free version of the game anymore. You've stepped into the version where the bank actually gets paid. And they don't need you to completely lose control. They just need you to stay in that cycle, spending, carrying a balance, paying interest, month after month. Because from the outside, everything still looks fine. You're making payments, you're not missing deadlines, you feel like you're managing it. But under the surface, the balance is working against you. And when you zoom out, this isn't just a few people making mistakes. In the US, total credit card debt has reached trillions of dollars, with average interest rates sitting above 20%. That's not random. That's the system doing exactly what it was built to do. So even though the idea of interest-free borrowing exists, for a huge number of people, it never stays that way for long. And that raises a bigger question. If banks make most of their money from people carrying balances, then why do they spend so much time advertising rewards? Why push cashback, points, and free travel so aggressively? And the answer to that is where things start to get even more interesting. Now, let's talk about the part that makes all of this feel like a smart move in the first place, because this is exactly where most people start convincing themselves they're ahead. The rewards. Cashback, travel points, bonus offers, everything is presented in a way that makes spending feel like progress instead of loss, almost like you're being paid to live your normal life. At a glance, that idea is hard to argue with, because getting something back will always feel better than getting nothing at all. But the structure behind it flips the logic in a way most people don't fully notice. The system doesn't reward you for being careful with money. It rewards you for moving more money through it. That's a very different game. Picture this for a second. You're using a card that gives you two. By this point, most people already know that credit cards are tied to something called a credit score. But what many don't fully realize is how deeply that number can influence decisions that have nothing to do with the card itself. A credit score is basically a reputation system built around borrowing, and it tells lenders how likely you are to pay money back after taking it. If you've borrowed before and handled it well, your score usually climbs higher over time, which signals reliability and makes banks more comfortable approving you for larger loans later on. But when payments are missed, balances stay too high, or accounts start looking risky, that number can drop faster than most people expect, and the consequences often show up in places that surprise people. For example, when someone applies for a car loan, tries to finance a home, or even signs a long-term lease for an apartment, that score often plays a role in whether they get approved and what interest rate they end up paying. In some cases, insurance companies check it, and certain employers in financial industries look at it as well, which means the number quietly follows you into different areas of life without always being obvious. Because of that influence, a lot of people start focusing heavily on building their credit score as quickly as possible. At first, that sounds responsible, and in many ways it is, because paying bills on time and keeping balances low are genuinely good financial habits. The problem begins when people start believing that using credit more often automatically improves their score faster, which pushes them to swipe their cards more frequently than they actually need to. It becomes a subtle feedback loop. You use the card to build credit, the score improves a little, the bank raises your limit, which then makes it easier to spend more, and the cycle keeps reinforcing itself without feeling dangerous in the moment. Over time, this system starts guiding behavior in a quiet way, not by forcing people into bad choices, but by encouraging patterns that keep them connected to borrowing. And that's where the interesting contrast appears. Many wealthy individuals do use credit cards, but their approach usually looks very different from the average user, because they treat the card like a tool rather than a source of spending power. Instead of relying on it to afford things they couldn't buy otherwise, they focus on control,
timing and cash flow, which keeps the system working for them instead of the other way around. Once you understand that difference, the conversation shifts from whether credit cards are good or bad to something more practical. The real question becomes how to use them without slowly drifting into the habits that trap most people, and that leads directly to the final part of this discussion.
So after everything we've broken down, the way credit cards work, the interest trap, the reward system, and how your behavior slowly shifts over time, the question isn't really whether credit cards are good or bad. It's whether you're the one in control, or the system is. Because at the end of the day, the same tool can work very differently depending on how it's used. Most people end up using credit cards as a way to extend their spending, which feels harmless at first, but slowly turns into a habit of relying on borrowed money to maintain a lifestyle. On the other side, people who stay in control treat a credit card more like a payment method, not a source of extra money. That distinction might sound small, but it completely changes the outcome. If you want to use a credit card without falling into the same patterns most people get stuck in, it comes down to a few simple behaviors that are easy to understand, but not always easy to follow consistently. The first is making sure that every purchase you put on the card is something you could have paid for in cash at that exact moment, which removes the illusion of extra money and keeps your spending grounded in reality. The second is paying off the full balance every single month, not just most of it, not just when it's convenient, but consistently, because the moment you start carrying a balance is the moment the system starts working against you instead of for you. Another important piece is keeping your usage under control, because maxing out your limit doesn't just increase risk, it also affects your credit profile in ways that can make future borrowing more expensive. And just as important, you don't need the most premium card with flashy perks to make this work, since a simple card with no annual fee is more than enough if your goal is to build discipline rather than chase rewards. Now, here's the part that often gets misunderstood. Yes, many financially successful people use credit cards, but they're not using them to spend more. They're using them to manage timing, protect cash flow, and sometimes capture small benefits without changing their behavior. They were already going to spend that money anyway. The card just sits in the middle as a tool, not a temptation. And that's the difference most people overlook. When the system is working properly, it feels invisible. When it starts influencing your decisions, that's when it becomes dangerous. So instead of asking, how do I get the most rewards? A better question might be, would I still make this purchase if the card didn't exist? Because that answer usually tells you everything you need to know. And once you start thinking that way, the entire system becomes a lot easier to navigate without getting pulled into it. If you found this breakdown useful and want more videos like this that explain how money systems actually work behind the scenes, make sure to subscribe, because most of the time, what looks simple on the surface has a lot more going on underneath. Thanks for watching.